Hi, I'm Steve Chater with TCT Property Management Services. I'm also the co-author of the book Hold. In that book, it became a national bestseller because we teach people how to build wealth by owning rental real estate. Some people choose to keep the house that they were living in and rent it out. These people are called unintentional investors, and that means that they purchased a house and they did not intend to rent it when they bought it. So let's talk about what real estate investors know that others might not. Some people were told that when they bought their first house, they purchased the most expensive asset. And while that's technically true, because an asset is something that you own that you hope will go up in value, when you turn the home that you live in into an investment property where somebody else lives, now you've created a real asset. Robert Kiyosaki, he was the author of the book Rich Dad, Poor Dad, and that's one of the best-selling books on building wealth. And one of the things that he said in there, he defined what an asset actually is. He said, your home is not an asset because it takes money out of your pocket, while an investment puts money in your pocket. So transitioning your single-family home into a single-family rental property changes the nature of the asset that you own into something that makes you money instead of costing you. If that's the case, you need to know how it's making you money. Well, first off, the number one way that real estate makes money is that it goes up in value over time. It appreciates in value. The average over the last half of a century, the last 50 years in America, is that real estate goes up in value about 4% a year. Well, 4% doesn't sound like a lot, but when it's 4% of the total value of the real estate, well, now we're talking. So let me give you an example. Let's say the value of the property is $500,000 today. Well, 4% of that is $20,000. And that's the average appreciation over time for real estate. Okay, 20% $20,000. Okay, that's significant. The next way it makes you money is when somebody pays you to use your property. Likely you'll have a mortgage on that property, and every time you pay the rent, part of that rent goes to paying down your mortgage. That could be $300, $400, even $500 per month. You're actually accumulating equity in your property. Your net worth is growing every month. The next way your rental property, your real estate asset, makes you money is the taxes that you would have paid to the IRS that you no longer have to pay. See, it's interesting. Most people experiences that taxes get taken out of their paycheck, and at the end of the year when they file their taxes, they wind up getting a refund. Well, the refund is because they paid too much tax all year long, and now the government gives them some money back. Unfortunately, the government doesn't give you any interest on that. However, owning residential real estate as an investment creates tax benefits. And these benefits include writing off all of your expenses. You see, the tax laws allow you to treat real estate, rental real estate, the same way that you would treat a business. That means that your taxes, your expenses are tax deductible. They're deductible against all the other income that you've made. So if you paid $1 in expenses, and let's say you're in the 25% tax bracket, that would mean that Uncle Sam gives you 25 cents of that dollar back. 25 cents. So it really only cost you 75%. It didn't cost you $1 because Uncle Sam participated and said, you can pay less in tax. A big tax saving is that the government allows you to pretend that the property is losing value every year. They allow you to pretend that you're losing money, and then you can write off the loss of that money. It's called depreciation. In other words, for tax purposes, the property is losing value every year, where, as we just said, it's actually going up in value. And you can write off that imaginary loss. So I'm going to use some round numbers here. Let's say your property is worth $500,000. The depreciation allowance in taxes saves you almost $4,000 in taxes. That's $4,000 you didn't have to pay the IRS. You're saving $4,000 that you would have paid to Uncle Sam, even though you didn't take a dollar out of your pocket. You got to save the $4,000 that you would have otherwise paid. I think you're starting to see how real estate is one of the best ways to build wealth. The same way that most wealthy people have built wealth. Appreciation, your property goes up in value. In this case, $20,000 a year. In addition to that, somebody's paying down your mortgage for you. So let's say another $5,000 in mortgage or principal reduction and $4,000 in taxes that you didn't have to pay. So immediately we're almost $30,000 per year in benefit to you because you shifted the nature of this asset, your home, from which you made the payments into an investment property. Of course, I'm using round numbers and projections, so you and your accountant will be able to figure out the exact numbers. It could be even more than we just talked about. Remember when I said you could treat it like a business? Well, the tax laws allows you to use depreciation in an even more powerful way, and it's called cost segregation. I'm not going to go into that in high detail right now. I just want you to know that you can write off the carpets and the air conditioners and the appliances much faster than you can write off the structure of the house. So what's the bottom line? That benefit's even more powerful. You see, at TCT, we know that property management is more than just collecting rent and fixing things when they go wrong. For almost 50 years, we've helped thousands of people just like you create millions of dollars in wealth by owning residential real estate that they rent out. And that's what we do best. If this helped clarify your thinking about owning rental properties, please click like or subscribe below, and we'll keep making more.